Let's discuss some risk-adjusted measures of performance. When one evaluates the performance of a portfolio manager, both the return and the risk must be considered. Therefore, the risk-adjusted returns, also called the composite measures of portfolio performance, are used. Let's discuss some composite measures of portfolio performance. Let's start with the Sharpe ratio, which considers the portfolio's excess return above the risk-free rate, which is the portfolio risk premium, and divides that by the total risk. Sharpe ratio formula is Rp minus Rf divided by sigma p. Rp is the return on the portfolio, Rf is the risk-free rate, and sigma p is the total risk of the portfolio measured by its standard deviation. Basically, the Sharpe ratio measures the excess return over the risk-free rate or the portfolio risk premium per unit of total risk. Total risk includes systematic and unsystematic risk. The Sharpe ratio answers the following question: how much return above the risk-free rate am I getting for the portfolio volatility that I'm bearing or taking? Volatility is measured by standard deviation. The higher the Sharpe ratio, the better the portfolio performance. That is, one is getting more excess return per unit of the total risk taken. Let's consider an example to calculate Sharpe ratio. The formula for Sharpe ratio is Rp minus Rf divided by sigma p. Rp is the annual return of the portfolio, Rf is the risk-free rate, and sigma p is the standard deviation of the portfolio. The Sharpe ratio for X is 12% minus 7%. 12% is the annual return and 7% is the risk-free rate, divided by 16%, which is the corresponding standard deviation, the standard deviation of X. The Sharpe ratio for Y is 15%, which is the annual return of Y, minus the risk-free rate 7%, divided by 18%, which is the standard deviation of Y. And the Sharpe ratio for the market is 16% minus 7%, divided by 25%. The Sharpe ratio for X is 0.31, that of Y is 0.44, and that of the market is 0.36. The portfolio X has the lowest excess return per unit of total risk. X underperforms both Y and the market or the aggregate market portfolio. Portfolio Y performs better than the portfolio X and the market or the aggregate market portfolio. Note that the relative rankings, Y being the best and X being the worst and market being somewhere in the middle, does not help us understand the degree by which Y is better than the market or X. If the Sharpe ratio of Y is greater than that of X by 42%, doesn't mean that investing in Y is 42% better than X, and it does not mean that if the return of X is 10%, that of Y will be 14.19%. Let's discuss another risk-adjusted measure of performance, the Treynor ratio. The Treynor ratio formula is Rp minus Rf divided by beta p, where beta p is the beta of the portfolio. Comparing with the Sharpe ratio, the formula is Rp minus Rf divided by sigma p. The numerators in both the ratios are the same. The Treynor numerator is Rp minus Rf. The numerator in the Sharpe ratio is also Rp minus Rf. The denominator of the Treynor ratio is beta p, which is basically the systematic risk measured by beta. The unsystematic risk or the diversifiable risk is not considered in the Treynor ratio. The denominator of the Sharpe ratio considers total risk of the portfolio, which considers systematic and the unsystematic risk as measured by the standard deviation. The Treynor measure measures the excess return per unit of systematic risk. The Treynor measure suggests that systematic risk is the proper measure of risk to use when evaluating portfolio performance. The higher the Treynor ratio, the better the portfolio performance. That is, one is getting more excess return per unit of systematic risk taken. The Treynor ratio answers the question, how much return above the risk-free rate am I getting in return for the exposure I am taking to the market sensitivity of the portfolio? This market sensitivity is measured by beta. Let's discuss an example. Treynor ratio formula is Rp minus Rf divided by beta p. For portfolio X, the annual return Rp is 12% and the beta is 1.5. For Y, the figures are 15% and 0.75, and for the market, the annual return is 16% and the beta is 1. The risk-free rate Rf is 7%. So the Treynor ratio for X is 12% minus 7% divided by 1.5, which is 0.033. The Treynor ratio for Y is 15% minus 7% divided by 0.75, which is equal to 0.11, and the Treynor ratio for the market is 16% minus 7% divided by 1, which is 0.09. The beta of the market is always 1. Portfolio Y outperforms X and the market because its Treynor ratio is the highest. Y delivers a higher excess return or market risk premium per unit of the systematic risk taken. X underperforms Y and the market portfolio. Again, the Treynor values or the relative rankings do not say anything meaningful about the degree of difference between these three portfolios as far as the performance is concerned. Let's compare the two ratios. We know that the numerators of both the ratios are the same. The portfolio risk premium or the excess return over the risk-free rate. The denominator in the Sharpe ratio is the total risk, which is equal to the systematic plus the unsystematic risk. And the denominator in the Treynor ratio is only the systematic risk. We can rewrite the formulas for the two ratios as follows. Sharpe ratio is equal to Rp minus Rf divided by systematic plus unsystematic risk, and Treynor ratio is Rp minus Rf divided by only the systematic risk. Therefore, if the unsystematic risk is 0, the Sharpe ratio will be the same as the Treynor ratio for the particular portfolio. In other words, if the portfolio's unsystematic risk were totally diversified, its Sharpe ratio would be equal to the Treynor ratio. Another way to look at it is that if the portfolios are perfectly diversified, that is, the correlation coefficient between the portfolio's return and the market return is 1, Sharpe ratio and the Treynor ratio will be the same. This is because the total risk measured by standard deviation will be equal to the systematic risk, since all the unsystematic risk would have been diversified away and unsystematic risk will be 0. The less diversified the portfolio, the larger the difference between the two ratios. All else being equal. So if you consider three portfolios, the relative suitability rankings given by the two ratios may be different if they are diversified to different degrees. We can say that the Sharpe measure accounts for the extent of a portfolio's diversification during the measurement period. If a portfolio is inadequately diversified, its performance ranking using the Treynor ratio is likely to be higher than its ranking using the Sharpe measure, because the Treynor ratio ignores unsystematic risk. As we know, unsystematic risk is higher if the diversification is lower, all else being equal. Another conclusion is that the Sharpe ratio can never be higher than the Treynor ratio. At best, the ratios can be equal. This is because the unsystematic risk can theoretically be reduced to 0 by diversification, but one can't diversify the systematic risk. Mathematically, the denominator of the Sharpe ratio is always going to be greater than the denominator of the Treynor ratio. At best, it can be equal if the diversifiable risk is 0. The numerators are based on historical returns of the portfolio. This fact reduces the relevance of the ratios for making future investment decisions. Also note that the numerators in both the ratios must be positive, else the results are not meaningful. For example, if the portfolio return is 5% and the risk-free rate is 7%, the numerator is minus 2%. And the ratios will lose their meaning. Further, the Treynor ratio is not suitable for portfolio or assets whose beta is negative. Since the Treynor ratio uses beta, which is a relative measure, the ratio can vary based on the relevant benchmark used to calculate the beta. For example, a stock can have a beta of 2 with respect to market index Y, and stock X can have a beta of 1.75 with respect to another similar market Z. All else being equal, the Treynor ratio will be different for X when you compare respect to Y or Z. Moreover, as discussed earlier, while the ratios can rank the portfolios in order of superiority, one cannot measure the degree by which one portfolio is better than the other. For example, if Sharpe ratio of a portfolio is 10% higher than the Sharpe ratio of another portfolio, it does not mean that the portfolio X is 10% more suitable than portfolio Y for investment. Let's now discuss Jensen's alpha. Based on the capital asset pricing model, the security market line equation is as follows. Expected return of a security or a portfolio I is equal to the risk-free rate plus beta into Rm minus Rf, where Rm is the expected return on the market portfolio, Rf is the risk-free rate, and beta I is the systematic risk of the security or the portfolio I relative to the market portfolio. And Rm minus Rf is basically the market risk premium. Now, portfolio's alpha is the portfolio's actual return minus the expected return. Note that Jensen's alpha is based on the SML equation and measures the risk-adjusted return as alpha. Basically, the equation is used to determine the expected return of a portfolio ERI based on the market return M and the risk-free rate F during the period and the portfolio's beta. The figure of expected and predicted return is subtracted from the actual return to calculate Jensen's alpha. Therefore, the equation becomes R actual minus Rf plus beta P into Rm minus Rf. Note that the equation ignores the unsystematic or the diversifiable risk or the idiosyncratic risk of the portfolio. This is because beta is basically a relative measure of systematic risk only. It does not consider unsystematic or diversifiable risk. A positive alpha indicates superior performance and a negative alpha indicates inferior performance. Let's discuss an example. Suppose the equity portfolio has a beta of 2.0, a risk-free rate is 5%, and expected market return RM is 12%. The expected return as per the security market line equation is RF plus beta I times RM minus RF, that is 5% plus 2 into 12% minus 5%, which is equal to 19%. If the actual return is 19.5%, Jensen's alpha is 0.5%, 19.5% minus the expected return. If the actual return is 18.5%, Jensen's alpha is negative, it is minus 0.5%. Obviously, while the alpha lasts, one would like to buy stocks that outperform the expected return. And one would like to short sell or liquidate the stocks that are underperforming based on the theoretical and expected return. Of course, course, buying and selling the outperformers and underperformers respectively will ultimately lead to zero alpha situation by pushing up the price and reducing the expected return of the outperformers, and selling pushes down the price and increases the expected returns of the underperformers. Let's now discuss the information ratio. The information ratio looks at the amount of excess return relative to the excess risk. The higher the information ratio, the better the performance of the portfolio manager. Higher ratio indicates that the fund manager is generating more outperformance per unit of the excess risk he is taking. The formula for the information ratio is information ratio IR is equal to alpha P divided by sigma PB. The numerator tells you by how much the portfolio has outperformed a particular benchmark. This is alpha of the portfolio relative to a particular benchmark. The ratio does not give meaningful results if the portfolio underperforms the index, because numerator will become negative. The alpha will be negative. The denominator is the standard deviation of returns with respect to the benchmark returns. This is also known as the tracking error. Therefore, the information ratio formula becomes portfolio return minus benchmark return divided by the tracking error, or portfolio return minus the benchmark return divided by standard deviation of the difference between the portfolio and the benchmark returns. RP minus RB divided by the tracking error. The alpha P here is the amount by which the portfolio has outperformed a particular benchmark. The alpha must be positive for this ratio to work. If you take an example, if the portfolio return RP is 10% and the benchmark return is 8%, and the tracking error or the standard deviation is 10%, the information ratio is 10% minus 8% divided by 10%, which is 20% or 0.2. Let's now discuss the appraisal ratio, which is slightly different as it divides the Jensen's alpha with the residual risk, which is the unsystematic risk taken to achieve alpha. Jensen's alpha, as you know, considers systematic risk only because the formula contains beta. Jensen's alpha ignores the residual unsystematic risk or the idiosyncratic risk. The formula of the appraisal ratio is portfolio's actual return minus the expected return, which is basically the alpha of the portfolio, divided by sigma p, which is the residual risk. We can rewrite this formula as R actual minus R predicted divided by sigma p, or R actual minus RF plus beta p into Rm minus Rf divided by sigma p. The residual risk sigma p is in the denominator is the unsystematic or the idiosyncratic or the diversifiable risk taken. The appraisal ratio calculates excess return or alpha generated per unit of unsystematic risk taken. Suppose the equity portfolio has a beta of 2.0, a risk-free rate of 5%, expected market return is 12%, the unsystematic risk is 5%, the expected rate of return ER is equal to RF plus beta I into RM minus RF, which is 5% plus 2 into 12% minus 5%, which is 19%. If the actual return is 19.5%, Jensen's alpha is 0.5% and the appraisal ratio is 0.5%, which is the Jensen's alpha. divided by 5%, which is the unsystematic risk taken. Let's now discuss the Sortino ratio. Let's first revisit the formula for the Sharpe ratio. The Sharpe ratio is equal to Rp minus Rf divided by sigma p. The denominator sigma p considers both the positive and the negative deviations from the mean return. Basically, the standard deviation in the denominator is calculated using returns which are both above and below the mean return. We take the entire data set to calculate the standard deviation. The Sharpe ratio is applied to portfolios with normally distributed returns with both positive and negative deviations. However, fund managers normally hedge downside risks with derivatives or short sell securities and market index. Also, they magnify the positive returns by leverage, creating positively skewed portfolios. So we should not penalize the fund managers for the positive returns. Basically, it would not be fair to penalize fund managers for having a high positive deviation. That means returns above the mean. The Sortino ratio focuses only on the downside risk. But why did we use the term penalize here? Why are the fund managers penalized if you use positive returns in the calculation here? Basically, the standard deviation is in the denominator, a higher standard deviation because of the incorporation of the positive volatility reduces the Sharpe ratio as compared to the Sortino ratio, which considers only the bad or the downside volatility. Basically, the Sortino ratio answers the question, how much negative volatility risk are you taking to get the excess return? How much negative volatility risk are you taking to get the portfolio risk premium? While the numerator of the Sortino ratio is the same as that of the Sharpe ratio, the denominator is the average of the downside volatility for the relevant period. The formula is Rp minus Rf divided by sigma negative, the negative standard deviation. Basically, the Sortino ratio calculates the amount of portfolio return above the risk-free rate per unit of negative volatility. Let's take an example to understand this. Basically, the Sortino ratio calculates the amount of portfolio return above the risk-free rate per unit of negative volatility. So if we have portfolios X, Y in the market, annual returns 12%, 5% and 16%, and standard deviation negative is 10%, 16% and 14%, and the risk-free rate is 7%, the Sortino ratio, which is equal to Rp minus Rf divided by sigma negative, is Sortino ratio X equal to 12% minus 7% divided by 10%, which is 0.5. The Sortino ratio for Y is 15% minus 7% divided by 16%, which is equal to 0.5. And Sortino ratio for the market is 16% minus 7% divided by 14%, which is 0.64. Therefore, if we consider only the downside volatility, the market beats both X and Y. Sortino ratio is much higher. Note that although Y's annual return is higher than X, its Sortino ratio is the same as that of X. Therefore, Y's manager took more downside risk than X to achieve the higher return. The point to be noted is that if you consider only the downside volatility, the rankings may be remarkably different from the Sharpe ratio.